The storm clouds gathering over Wall Street are darker than most investors realize. And America's most influential banking leader is sounding an alarm that many would prefer to tune out. The probability of a dramatic collapse in U.S. equity markets looms substantially larger than what financial professionals have collectively accepted, according to the chief executive of the nation's largest financial institution, Jamie Dimon, who commands the boardroom and executive suite at JPMorgan Chase, the formidable banking titan that dominates America's financial landscape, has revealed he's experiencing considerably more anxiety than his contemporaries about a potential market cataclysm. His forecast suggests this financial disruption might materialize within the relatively near future, potentially unfolding anywhere between the next 6 months and the coming 2 years. I would assign it a significantly greater likelihood than what appears to be reflected in current market valuations and in the assessments of other observers. Dimon confided in an interview with BBC journalists. To illustrate this divergence, he provided a striking comparison. If market participants are collectively factoring in approximately a 10% probability, my own analysis suggests we should be contemplating something closer to 30%. The JPMorgan leader pointed to a constellation of brewing pressures, creating this atmosphere of financial unease. These potential economic disruptors include escalating geopolitical confrontations, expanding government expenditures across Western economies, and what he characterized as an accelerating trend toward global remilitarization. But here's where it gets particularly concerning. All these converging challenges create numerous complex questions that we don't currently have adequate answers for, Dimon acknowledged. For this reason, I believe the degree of uncertainty should register more prominently in everyone's consciousness than what we've grown to consider ordinary market conditions. And this is the part most people miss. Dimon isn't a lone voice in the wilderness of financial warnings. His cautionary perspective joins an increasingly vocal chorus of prominent economic leaders, signaling that equity markets may be positioned for a substantial adjustment. Just days earlier, International Monetary Fund Managing Director Kristalina Georgieva observed that despite the global economy's unexpected resilience during recent trade tensions initiated by the previous administration, significant hazards continue to accumulate. Her guidance to financial observers? Fasten your seatbelts. Uncertainty has become our new baseline reality. Before anyone allows themselves to breathe a premature sigh of relief about our economic stability, please consider this warning carefully. Georgieva urged an attentive audience at Washington's Milken Institute. The world's economic resilience hasn't yet faced its ultimate examination, and troubling indicators suggest this examination may be approaching faster than many anticipate. But here's where the controversy really ignites. Simultaneously, financial experts are growing increasingly vocal about what they perceive as a dangerous asset bubble inflating around artificial intelligence enterprises. The Bank of England amplified these concerns midweek, highlighting an increasing probability of a swift market adjustment that could send shockwaves through global financial systems. When addressing the artificial intelligence investment frenzy, Dimon acknowledged the uncomfortable reality that a portion of the capital flowing into AI ventures will almost certainly evaporate. However, he provided crucial historical context. My assessment is that AI represents a genuine technological revolution whose long-term economic benefits will ultimately materialize. This trajectory mirrors how automobiles and television sets as industries ultimately delivered substantial value to society, even though, crucially, the majority of early investors in these sectors failed to capture meaningful returns. This tension between transformative long-term potential and near-term financial risk represents perhaps the most challenging dilemma facing today's investors. Are we witnessing another historical technological transformation, or are we merely participating in a speculative mania destined to end painfully? The divergence between Dimon's grim 30% probability assessment and the market's comparatively complacent 10% valuation raises uncomfortable questions about whether we're experiencing another instance of collective denial that historically precedes financial crises. When the captain of the financial world's largest vessel is reaching for his life jacket while most passengers remain unconcerned, shouldn't that at least give us pause? What's your perspective on these warnings? Are Dimon and other financial leaders being unnecessarily alarmist, or are they providing the candid assessment that investors desperately need but don't necessarily want to hear? How are you positioning your investments in light of these potential risks? And do you believe the AI revolution represents genuine value creation, or simply the latest investment bubble ready to burst? Share your thoughts in the comments below. Agreement or disagreement, all perspectives are valuable in navigating these uncertain financial waters.